Hello, stock investors. Welcome to my live stream. This evening's live stream is going to focus on stock analysis, taking a look at individual stocks as well as themes that are going on here in the stock market. What I'm trying to do is figure out how can I outperform the market. The market has been doing quite well for the last 2 weeks, I would say. Last week was really good. This week has been mixed, but overall, I'm ahead of the game this week, so I will take it. This week, we had some stocks really move up and some other stocks move down. Today, specifically, Nvidia had a real good day. I believe their CEO is at the White House visiting President Trump, and I think the market really liked that. I think he's trying to probably get that administration to open up the ability for Nvidia to sell chips to other countries, specifically China. But the semiconductor space, a lot of it went down considerably. It may have been that our friends over at Meta announced that, hey, they're not going to spend as much on the metaverse, which is where a lot of their infrastructure spending is for their data centers. And that reduction is positive news for Meta. That means their financials are going to be better. So that's why the stock went up. But it's negative news for those that wanted to sell them a bunch of stuff, a bunch of semiconductors. So that space went down today. Apple had a rough day. Microsoft had a rough day yesterday, and it came back a little bit today. The software space is something I've been looking at for quite a while and think that this could be a really good spot for some good investing. And today, CRM went higher. We'll take a look at CRM. They announced their earnings yesterday, and the stock went up today, 3.66%. It got off to kind of a slow start, but then it picked up some momentum and did quite well. And some other software stocks announced this week. The other one that I'm going to cover is Path, which had a very good day. That stock was up nicely. Apploving was up nicely. And of course, Meta was up. So we'll cover Meta. Computer hardware was up. So this whole space was looking good with a few exceptions. Looks like we've got Mark on the stream. Good to see you, Mark. Thanks for joining. Benton, great to see you. Google is down and you were buying. That's good. Google has been on a tremendous run, and that's my biggest position. So I'm not buying Google right now just because the market did all my work for me as it bid up the stock. Now I've got plenty of ownership in Google. I am good to go there. Looks like NBIS was up after being down, in and out of that position. Okay. And is that Nebius? That one's a risky one. Interesting. Bo, good to see you. Great to see you, man. I'm doing well. I'm doing excellent. It's Thursday night. I've got the football game going on here in the background. We're going to see the Cowboys visit the Detroit Lions. That should be a good game. The teams have roughly similar records. Just one win sets them apart. And the Cowboys have been playing well. They've been showing up. I think the Lions are a good team as well. It's going to be a high-scoring match because the Cowboys can score points and so can the Lions. Who's going to win tonight? All right. Now we're having some fun. You know, I'm going to pick the Cowboys. I'm not a Cowboys fan. I'm not a Cowboys hater. But I can just tell you, the last 2 wins have been against quality opponents. Last 2 wins have been with the team dealing with adversity. And I think that the Cowboys are building a little bit of confidence, a little bit of a, win streak. And you can't say the same thing about the Lions. I think the Lions, who did they lose to? I think the Lions lost to, was it the Bears? They lost to somebody last week. And I think the Lions are a good team, but they just lack the finishing touches, I guess. And we'll see what happens. So Benton, our rubric. Yeah, man. Some of these stocks could really hurt us, right? Let's take a look at rubric and try to revisit what I think I was seeing. And I'm not going to get them all, but sometimes I could point to something and think, um, man, that there's just something there that doesn't look good. For example, the one thing I will point to is, snow, which is snowflake. I pointed to that one and just called it out. It's overpriced. And they announced good earnings. And guess what? Stock price went down. I don't think it's going to stop going down. So we'll see. Thank you, Blocks for Fun. It was the Packers. That's who they were playing. And, the Packers beat the Lions. And I think they beat them. Where were they playing? Were they playing in Detroit or Green Bay? I don't know. But that was a good game. Classic, right? Good to see you. Blocks are fun. Benton. Yeah, Core Weave. Man, let's cover Nebius and Core Weave because I think we need to just remind ourselves, what are these businesses? What do they do? Right. And happens to be an area where I do have experience. There's some industries where I have to analyze companies from a distance. For example, GenMab. GenMab has been doing great. I started buying into GenMab this week. Other investors on this stream and in the community had brought that one up. We've been talking about it through 2025. It's been a good stock. Well, I don't know the biotech that we're dealing with there. I can only analyze high level. What is it they do? They help people with certain conditions. Okay, that's great. I look at the financials. Once we get to the financials, that's my strong suit. And I can assess if it's an attractive business, if it's desirable. But when it comes to Core Weave, Nebius, cloud infrastructure, it is something that I know quite a bit about. So I could kind of talk about the Core Weave business and Nebius and just point, what are the risks, right? Every stock is going to have a risk level. Some are super low risk, some are really high risk. We'll talk about that. I think it's worth repeating. And I think as we see the AI era and where these massive investments are being made in data centers, we have to watch it because we don't want to be sitting on a stock that really goes to zero or nearly zero. Man, the chat is on fire tonight. You guys showed up. Thank you for showing up. So Rubric is up in after hours. Cool. Let's take a look. Yep. Packers are good. I think the Packers have, man, the NFC, is it the NFC North or Central? The Bears played really well. And I think the Bears are looking good, but they're a little bit unproven. The Packers have been good for a little while. They're really good. I think the Packers are good. The Eagles are good, but man, they can have bad games. So the NFC, the Rams have been playing well, but they lost against Carolina. Not to disrespect Carolina, but the Rams had the best record in the NFC, and then they lost to the Panthers, which is a surprise. So now the NFC West has, I think, 3 teams with 8 wins. So probably 3 teams are going to go to the playoffs. They're going to have to battle it out to see who wins the division. All right. So, yeah, that's what I remember about Rubric. And, the thing about that industry, that's a really good industry to look at. We're going to look at it because it's not like they're the only company doing cybersecurity. You've got like 10 companies. So picking the best one is ideal. And for all we know, Rubric will be a nice discounted stock. We'll take a look. Yep. So we're on the same page there. Yeah, the NFC is up for grabs. And the AFC, what's interesting is I did not see the Patriots coming. How did the Patriots get this good this fast? Because they seem to be really good and they play defense and they got a quarterback that can really throw the long ball. Um, the Patriots seem to be for real. And what other teams? The team that surprised me to the, I guess, um, surprised me that they're not doing better are the Bills. I thought the Bills were going to be really good this year, but they're kind of in the middle of the road for the AFC. And yeah, we'll see. Also, the Houston Texans, man, those guys play defense. I like how they play. They play hard. Good team. So it's wide open. We'll see who ends up in the Super Bowl and who plays for the championship. We're months away from that, but December, January is like that's the best time for NFL football. That's when games begin to really matter and things are getting set up to see, okay, which teams are going to be the best teams. It should be a lot of fun to watch. So good. Thanks, Bo, for the super chat. I am familiar with Brookfield. I've looked at it a few times and we can look at it again. So we can take a look at that guy. And not a Rams fan, Chargers, support the Chargers, and the Chargers may make it in the playoffs. I don't know that the Chargers are ready to take the rest of the NFL on, but they're trying, and they've got a good coach. We see if they can get a little bit of consistency going. I think they have the talent, but sometimes they just they can't get it going, and that's a sign of a team that's not going to make it. Teams that can win even when they're not playing their best, those are the teams that are going to be championship caliber teams, and they have good defenses. So we'll see. Oh, so the quarterback broke his hand. Okay, well, there goes the Chargers. Yeah, Harbaugh, man, that guy's intense. It's great. Good. He needs to inspire his team. So we'll see how it goes. All right, so let's get cooking here. Let's get cooking. Let's get into some stocks and see what's going to happen. And what I'll come back to is kind of point to some things that I'm beginning to observe as we trade here in December. In December, I'm expecting we're going to have an interest rate decision next week. I think everybody expects a 25 basis point reduction. Okay, cool. Everybody's got that priced in. Earnings are going to continue, but not as intensely as we had like a month ago. So we should have a Santa Claus rally. And then we start 2026. And it's like a brand new season in the NFL. And with that in mind, I'm already beginning. Okay, so as I look at my portfolio, how could I set up a good 2026? I think I'm in a good spot, but I'll also add some comments later on about that. How to manage one's portfolio, focusing in on what's likely going to work next year. And Mark, I could put eToro on the list. I'd be happy to. eToro is a stock that I'm watching quite closely. I own eToro. All right, let's get going. I think there was a super chat brought up for BN. We can get started there. And this company, so thanks, Bo. So yeah, and there's two Brookfields, right? There's Brookfield Corporation, or maybe I'm getting this mixed up with somebody else. Let's take a look. So Brookfield Corporation is a multi-asset manager focused on real estate, credit, renewable power, transition infrastructure, venture capital, private equity, including growth capital, emerging growth investments. It manages a range of public and private investment products and services for institutional retail clients. Okay. So it's putting capital in places it believes are really good investments. It's an asset manager, financials. Okay. Let me just check something really quick because I think there was. So this is that's a normal stock, but I think there's Brookfield Infrastructure Partners. Yeah, there's all these Brookfields here. So you wanted to look at, let's see. So BN, right? Man, there's a lot of Brookfields. So was it this one here, Bo, that you want to look at? Or because these guys do renewable power and so forth. And they're all part of this Brookfield family. Let's look at the the investor page. And you'll see how it's all laid out. Like there's kind of a parent company and then a bunch of companies underneath it. So this is Brookfield Corporation. They have asset management, wealth solutions, operating businesses. So, and then they have 73% ownership in Brookfield Asset Management. Okay. So that was BAM. Okay. So if this is all true, I mean, this is pretty strong, right? 19% annualized compounded rate of return. That's really good. Okay. So that's what they're doing. And these guys, you can think of them as kind of a Berkshire Hathaway. They're investing in opportunities that fit that particular year, that era. And it's not a bad idea. And they're probably investing in data centers and where their capital is needed. Let's take a look and value the company. So they're a $105 billion market cap company, revenue 77 billion, and they pay a small dividend. Analysts think they're a little expensive. Over the 1 year, they've gone up 14.85. That's not bad. 5 year up 71. They had a pretty good sell off, probably when things were selling off in 2022. They had a lot of their assets lose value, lose price, and then they recovered nicely. Okay. So these guys are really a conglomerate, a holding company for a lot of other businesses. So it's not going to be one specific type of business. It's not like we're looking at Meta that does social apps or eToro that does financial services. These guys are predominantly capital markets investing, but across different industries. When we look at the quarterly, what's been going on? So I'm seeing some red here, and the revenue line has been coming down. One thing that has hurt these companies is the expectation that you're going to have lower interest rates. And then when Brookfield makes their next deal, they're not going to have as high of a rate of return because whoever needs the capital is gonna have lower rates that they would pay, whether they get the capital from Brookfield or somebody else. The risk-free rate is lower now, so that's going to be a lower amount of revenue that would go to a Brookfield on future deals they do in 2026, and deals they probably did in 2025. They are profitable. Looking at some of their metrics like profitability and so forth, let's take a look at that. So they've been operating with negative cash flow, 31% gross margins. I think, why are they so unprofitable? That's interesting. So operating margins. Yeah. It's interesting how low their profit is. And they don't have any free cash flow. All right. So we've got 7 analysts covering them. There's no agreement on what this stock is worth. Some analysts have price targets at 59 and other analysts at 27. So on average, the stock is priced too high by 9%. When we look at a forecast, this is the year we're in. And these numbers look really weird. They look bizarre. How are we going from such high revenue down to this level of revenue? Okay, so that doesn't make any sense. Okay, so I'm not going to trust these numbers. I'm going to go straight to their website. Those numbers didn't look credible. All right, so that's Brookfield. We'll look at their financials directly. Now let's look at BAM really quick, which is related. This is a pretty big market cap, and Brookfield owns, I think it was close to 75% of this. They do pay a nice dividend, 3.31. This one might be more attractive because of that dividend. Some investors like that dividend because they're retired. They just like seeing money come in. These guys have a different valuation. Analysts are saying, hey, these guys are discounted. Year to date, not doing all that great. So this one has not been appreciating. How about the 5-year? 5-year looks okay. It looks like for short periods it was doing great, but then it gave up those gains. Overall, though, the upward trajectory looks okay. 62.5, and you got paid a 3.3% dividend. So over 5 years, you add like 17, 18%. You're at a healthy appreciation plus dividends. So that's not bad. It's not great, but it's not bad. So 10 analysts cover BAM, and analysts are in a little more agreement than BN. You have price targets that are somewhat near each other, and you have a 19.77% discount. The revenue is growing for this organization, and their profits are expanding faster, which looks good. So that's good. Good looking forecast. And one thing I didn't look at, but I can look at it here, is the rate of free cash flow. So their cash flow is 1.77 billion. Okay, so I noted that because I'm going to need it. And when we look at the balance sheet, they have a little bit of debt, not too bad. I don't think it's a problem. No, a little bit of debt. No big deal. Okay. So I don't know that I have Brookfield in my valuations, but let's take a look. I don't. So let me take a look at this one more time. So these guys are considered an asset management company. Alternative asset management, headquartered in New York. All right. Okay, so what are they investing in? Let's see if we can get some details there. So they're investing in infrastructure, renewable power, private equity, real estate. Yeah, okay, got it. And the data center is growing, and then the need for power is growing. And most definitely, they're probably lending out. Looks like they did business with Bloom Energy. Okay, so this is a pretty hot market, right? A lot of data centers are being built, and the power that they're going to need as well. There has to be power generation and so forth. So, and that's not going to like go away overnight. I think that demand is here to stay for a while. All right, so let me do a valuation here on BAM, and we'll see what it's worth. So Brookfield Asset Management. Let's take a look at, so where I'm going to put these guys. I'm going to put them around financials. So I'm going to make some room here, and then we're going to do a valuation for Brookfield. We're going to use symbol BAM because symbol BN, the financials were really mixed. But this one, the financials look pretty darn good. So they were growing at a good clip. And the forecast was that they would grow very good growth, 14% across the board. Profits are going to grow nicely too. So that looks good. So we'll grow that by 14. And we'll go trailing 12 months plus growth. Right. Got that there. Cash on the balance sheet was $1,060,000,000. So you can see a very high discount. The cash flow looks really good. Okay. And I'm going to look at one more thing before we're done here, but let me update the earnings per share information, and then we're going to come back to free cash flow. So for 2026, it's going to be $1.88. They're growing nicely, so we got to give them a decent PE. And the growth rate, they're growing it by 16 or 20, so let's go with 15. All right, so before we're taking this number, let's take a look at their history. of free cash flow. And is this year just kind of an, an unusual year? Let's take a look. So they've had about the same cash flow for a couple of years. 22 was a negative year because it was a terrible year for investing. So if the markets are bad and asset values are going down, these guys are not gonna have a good year. They're gonna have a bad year. But when assets are climbing, they do really well. And on the trailing 12 months, we're using a number that is, so that's kind of consistently what they've been doing. So I'm good with that number. So this company, now let's think about how's 2026 look for these guys. It's probably going to be good. We have lower interest rates. So whatever debt they own, it's going to be more marketable, and it's actually going to go up in value, because if interest rates fall and let's say you have somebody that owes you money at 10% interest, well, you get to charge them 10% interest. You're locked in. That's a contract unless they refinance and buy you out. So with regards to lower interest rates, that's going to be good for Brookfield. The economy. I think the economy's okay. It's not great, but it's not bad. It's just okay. There's some areas of the economy that are going to struggle, but there always is an area or two that are going to struggle. But in general, I think the economy is going to be okay. We don't have a big unemployment problem. We don't have any big problems. So I think the economy is going to be fine. I think that asset prices are going to go up because of those low interest rates. We also have an administration in Washington, the president, that is really using the stock market as, in my opinion, as a kind of a metric for the job he's doing. He really cares that the stock market go higher, that the economy is doing good. That's one of the things that he prides himself in. And I would say that most presidents do, like, they care about that. This one more. He was a businessman, and he's really going to want the economy to do well. Having said that, that's probably going to be a tailwind for these guys. So overall, if you feel good about, Brookfield, it's probably going to do well. It was a consistent rising stock. Keep in mind, like when we look at the 5-year, if you draw a line, it has upward trajectory. I like that about it. The one thing I don't like about businesses like this is that it's a company that has many different businesses in it or investments. And it's not just one. We can't get our, hands on, like, for example, Netflix. We know they do video streaming. That's what they do. If their subscribers grow, that's a very positive thing. We can then assess, is Netflix operating really well? Are they making themselves bigger and better and so forth? It's clear to understand that with Netflix. When it comes to a Brookfield, they have so many different pieces that it's almost like, you make a spaghetti sauce and you put so many ingredients. You're like, man, this tastes like a lot of ingredients. You can't really, make out the garlic or the onions or whatever spices you put in there, because you mix a lot of ingredients and you don't know what's making it better or spicier or sweeter. Brookfield's a little bit like that. It's got so many ingredients that, okay, how do I know if they're doing well? So that is one of the things that I find undesirable, is I can't clearly gauge if these guys are doing well or doing poorly. And I think other investors are going to feel the same way, that, hey, I don't know exactly when to feel like these guys are doing great or doing poorly. So, but I think the business has proven to be successful. If you look at an investment and it shows 62% rate of appreciation with a nice dividend like this, I would say a lot of dividend investors are attracted to this. So I would say this particular stock is marketable. All right, so those are my comments there. Thanks for asking. And BN is the holding company. And looks like we have some more comments there that I'm going to get to. And we can look at Halo for sure. So let me just update my spreadsheet here, or my Google Sheet. I just want to make sure I come back and add this company and start following it. So put it right in here. And if you're an advanced member or higher, you get to look at my repository evaluations. I'm going to be updating it this weekend. And so if you go on that shared folder that you get access to, you can find the repository, and then you can go in and look up valuations that I've done in the past. And again, I'll be updating it this weekend. So take a look there. You also get a copy if you're advanced or higher member. You get a copy of the model I used, a working copy. So all right, and we will just update this field, and then we'll move on. Okay, so let me check the chat here, and then we'll keep working on stocks. Thank you, Bo. Great to see you. You are a regular, sir. So I think I explained the difference between BAM and BN. BN is like a big holding company. And yeah, they are like Blackstone. I agree. And I don't invest in Blackstone or Goldman Sachs and BlackRock. Okay. Yeah. And because it's a little bit of a kind of a black box to me. Like, when do I know that they're doing well or poorly, right? I'm just depending on, hey, I believe in them. But that's a little too unpredictable for me. I'd like to have a better sense of, for example, I kind of sensed that Google was unappreciated. I understand Google's business. I could form a theory that I felt was right, and I invested big in Google. Made out really well. I have the same type of conviction with Meta because I understand their businesses. I can't get to that conviction level when it comes to BN for sure, and then BAM as well. So that's how I think. I don't know. I don't know about you. All right, so we're going to go over Halo next. And then I think Barbacoa. I've owned BN for 4 to 5 years. Just sold a third. And you bought into Constellation SW and Progress SW. Cool. Thanks for weighing in. All right, so we're moving to Halo. Let's take a look at that particular stock. So this is, I believe, a healthcare stock. Halozyme Therapeutics, a biopharma company, researches, develops, commercializes proprietary enzymes and devices in the US, internationally. The company products are based on the patented recombinant human, and you guys will have to read that word. Okay, injectable biologics. Okay, so Okay, so their drug delivery is part of what they're doing. So injectables and pens. Okay. Okay. Got it. And okay, so 1 year. So this one here, man, it's had some pretty good drops, but overall it's been a good stock, up 30%. It announced November 3rd, and that was around here. And the stock rallied nicely. More recently, it's been coming down. I wonder why. I mean, this is a winning stock, right? Up 32%, has a really low forward PE. So we'll check it later, but we're going to check the patent cliff for these guys, or the how many more years do they have remaining on their patents. We'll also look at their forecast. This is a small cap, $7.4 billion. And low PE as mentioned. It's discounted according to what analysts are saying. We're going to look at just quickly their growth rate. So they've been growing nicely, and over the last couple of years, they've grown really well. In the quarter, it's looking good. Okay. Trailing 12 months looks really good. They cash flow very well. 602 is their free cash flow. Very good gross margins, excellent profit margins, and free cash flow is great. So looking at what 12 analysts cover it, you have some analysts who are saying it could go much higher. Some analysts are like, it can go a little bit lower. And the growth is supposed to continue for a year and a half or so, and then it's going to stop. Okay. So this is potentially when the patents are going to expire, and then their drugs are going to go generic, meaning prices are going to collapse, profits are going to collapse, competition is going to enter the space. When we look at the quarterly forecast, we're dealing with this quarter, and we're supposed to see some pretty good growth in the quarter that they're operating in right now. And the Q1 for 2026 is going to look really good. So the next 4 quarters look fine. In fact, it's going to get pretty exciting when these numbers get released, because the market may just not help itself. If a company grows 45%, man, that's really good growth. So that looks good. Their earnings per share next year will be $8.14. Okay. All right. So let me copy their name. Let's go over to Gemini, see if Gemini can help us out. And we're going to ask, what is the patent? I guess it would be the patent. Yeah. Patent, is it the patent cliff or? All right, let's see if Gemini can browse the internet and get us some good information. Okay, as of December 25th, that's this month, Halozyme's core U.S. patent for NHAMS drug delivery expires in 2027. So we are less than 2 years away from expiration. We are close to the end. Okay, that's very important. I think blocks for fun, you asked. This is really important. What happens after that, right? So they might have a little more time in Europe. In the US, they lose the patent. In Europe, they may have like another year and a half. So there were about 3 years from that happening. So they have some co-formulation patents that are going to give it more life, more cash flow, more profit flow, and they're trying to develop new technologies. But this is going to be a factor with investors. They're going to look at this date and they're going to be afraid of that date. Okay. And looks like DJ's got some comments here. So it looks like they acquired a new company, which will provide some new sales opportunities. That's good. Okay. So this one here, let's value it, and then we're going to get back to, I'll give you my opinion on how I would invest, but just one investor, right? You need to make the decision for yourself on, what's your risk tolerance? How long would you want to keep this stock? This seems like a risky stock to hold for 5 years because it's small. And we already saw that there's going to be some milestones that are quite threatening when they lose their patent. So keep that in mind, but let's do a quick valuation. I think I already have a valuation going. I just need to update it. All right. So the last time I valued the company, it was discounted, and we're probably going to end up with a nice discount again. But let's do the work here, and I'm going to update this forecast a bit because I'm not expecting that they're going to keep growing. So let's do some work here. So this is a small cap. So I was going with the higher discount rate. Okay, and the trailing 12 months cash flow looks good, 602 million. All right, and their growth rate is good for the next 2 years. I'm good with 20%, but it's these years that are not going to grow as well. So I'm going to go with 2 growth rates here. So we're going to go with growth on 2 and 3, and then we're going to go here 3 and 4. And 3 and 4 is going to be 5%, and here we're going to go 20%. Okay, so for here, I'm going to grab the first growth rate. This one's fine. Oh, no, this one's not fine. This one needs to be changed. And then this one is fine. Okay. All right, so that's more realistic of a forecast. And if they lose revenues, what's going to happen? So I don't think there will be a growth rate. So 0 and 0. And the reason I'm going zeros is you lose your patents, maybe your revenue contracts. So it's kind of for the next 2 years, you're doing well, and then it's going to flatten out. And you see how the level of discount really went down. So I'm trying to be realistic on what's going to happen here over the next 4 years, and then terminal value. Terminal value being all the years that we expect after year 4. All right, let's update cash and total debt. So cash is 701 million. All right, so we have a small discount based on cash. And now let's look at earnings per share. Earnings per share is like the most cited, metric on Wall Street, but it's not the metric that these successful, famous investors have used. They use free cash flows and they discount those cash flows. Earnings per share is supposed to be $8.14 for next year. P ratio, I'm going to bring it down to 12, and we're going to have zero growth there. So this stock here is painting a picture that there's a limit on the value of this company. Most companies, there's kind of an established expectation that they're going to be around forever. And I know that no business is going to be around forever, but what's the difference between forever and 20 years? Not much. When you're investing, and maybe you'll be in an investment for 5 years, right? But when we deal with a company like this, where there's definitely going to be some milestones that are threats, you need to be conservative. Or in my opinion, I want to be conservative and not take any undue risk. So for me, this one here, if I was invested, I would really think about an exit strategy. I would really research the company, because you may know that, hey, Halo is going to really try to continue to grow the business. That's fine. Most investors are going to see that patent cliff and be afraid of it. So just be aware of that you may love the company or you may not love the company. No big deal. But you just want to be aware of those milestones and exit the stock when you exit under the best terms for yourself as possible. So those are comments I put out there, and hopefully you found them interesting. That was a good one to go over, because it's got some moving parts that are good to figure out, and good to see you. Blocks for fun. Thanks for asking. All right. So DJ weighed in. Thanks, DJ. So DJ wants to look at INCY and TOST. Yeah, we can look at those. Let me catch up on the chat, and then we'll get on it. Anderson, good to see you. Yeah, Path went sky high. Wasn't it awesome? Yeah. So, Path, I think we talked about at length two days ago, and it was beginning to show acceleration on the growth. And we'll look at it a little later. I'll maybe save my comments for that point, because I had it on my list. We'll definitely look at it later. Good to see you. Jeff, Zim is back. That's right. But Zim is, man, it could be back for a week and then be down just as much the following week. It's just not a stock that you can hold for 2 years. That's a dangerous mission. If you get into Zim, and how I've played Zim is get in at a really low price and have an exit plan. Like once I hit that number, I'm up 25%, I'm out. It could go up another 50%. I don't care, because it can go up and down in a month. It could go up 15% and then drop 30. So I don't want to be caught on one of these drops that Zim tends to have. But thanks for bringing it up. All right. So we're moving on to INCY. Not familiar with that one. Insight. Is this? So Insight is a biopharmaceutical company, engages in the discovery, development, commercialization of therapeutics in the US, Europe, Canada, Japan. The company offers Jakafi for the treatment of intermediate high risk myelofibrosis. Okay. So we're going into healthcare this evening. Great. It's been a space that's been working, and I think it's going to keep working. All right. So they innovate. That's fine. So what we do, their portfolio, let's take a look at that. So have 9 approved products. And they have a pipeline. They have products coming. Okay. So this looks good. They have a pretty solid pipeline. Okay. So I'm generally kind of aware, okay, this is biotech, biopharma. Now let's look at the numbers, and then we'll go back to Gemini. Ask Gemini what the pipeline of new drugs looks like for this company. Market cap's a little bigger than Halo. It's 19.7. And over the 1 year, this one's doing well, 39.5. 5 year, not as good, but you see how it's not about, where the stock's been, it's where it's going. Last year, that looks really darn good. Okay. Let's take a look at their revenue. We'll look at what their patent, how much time is left on their patents. What does their pipeline look like? And all that good stuff. So they haven't had like super impressive growth for a smaller business. Good growth, but not super impressive. When we get into this last 4 quarters, it's gotten better. You see the acceleration. They went from 8.9, 9, 23, 16, 19.5, 16. So there's definitely an acceleration in their business. That looks good. So the revenue looks good. It's accelerating. Gross margins are not as high as I thought they were going to be, but maybe as they get bigger, they're going to expand their margins. The net profit's pretty good. 24.7 is actually good, not pretty good. It's good. And the free cash flow margin is also good. So those numbers look good. And I think the numbers are showing us that as the numbers really improved, the market started to pay attention and it started to pick the stock up. It started to really pick up its stock price. And let's see what their forecast looks like and see if the market's going to continue to be excited about this stock. 17 analysts, which is a good number, are covering the stock. There's some analysts that think it could go higher, and some analysts think it should go down lower. Their growth rate this year is really doing well, but for some reason it's supposed to slow down and have like 2 years at around 10% growth and then really slow down. So this is a little concerning here. Why would they be slowing down? Okay. All right. And specifically quarter by quarter, we're in this quarter here. They're supposed to come in at around 17% growth for the quarter we're in. And then first quarter of 26, they're going to be at 20% growth and then start slowing down. I don't like this slowdown. Don't like it. It may hold the stock down. If investors are seeing that slowdown, they'd be like, "Oof, I'm afraid of it." All right, Gemini. Let's put Gemini to work. See if Google deserves that big stock price they have now. All right. So it's set to expire in 2028. So they have about 2 years left where they can operate with the patent protection, and then they're going to see those generics come into the market and reduce the amount of profitability in the product. Gemini also gave us so they also have a topical cream. I don't know what the revenues are, but if you wanted to invest in this business, or if you were interested in this business, break down their income statement, because they will break this out like, hey, this is how much revenue we get from Jackafe, and this is how much we get from this one and this one, and see if these are going to be material. They're going to make up the gap and maybe even exceed the previous drug. Because if you do that homework and you see it, and maybe the market's not paying attention close enough, you can take advantage of it. So that's the homework that you would have to put in if you're going to invest in the stock and stay in it for a while. Right now, there's that question mark, right? If their business is going to start contracting in 2 years, we're probably in the danger zone already. Investors are going to be afraid of it. Any hint of it slowing down, we're going to have problems. Let's take a look at the financials real quick and see if they break out the different drugs and in their financials, kind of breaking it out. Hey, this is how much we make here. This is how much we make there. So that's 2024. So let's go here. And usually they break it out on these presentations to tell us. So here's product revenue. This is their big drug. In the quarter, it was 791 million. Okay. This one, see how the amounts, 188 million. So it's not as big as that big drug. It's like one fourth. Yeah, about a fourth of that number. And this one's even smaller. So I don't know if these drugs are going to make up the gap. So you got to put those numbers together and see, what's going to happen in 2 years? Our revenue is really, really going to come down, because the company looks exciting while it grows and it grabs a lot of investors. But if we see revenue wane and it starts to go down, I could see this stock losing a lot of interest from investors. Let's take a look at evaluation, and then we'll move on. So I don't know if I have a valuation for these guys. I don't, but we can create one. No problem. Let's we can pop it right here. I have a lot of healthcare stocks in the repository. Healthcare has been a place to find discounted stocks for the last 2 years. Now they're beginning to work. They're really discounted. They're going to work for probably a couple years, especially these growth stocks. You get lower interest rates, it really helps growth stocks because investors are like, man, I'm going to earn very little in bonds. I'm going to earn very little in these safe investments. I'd rather take a chance on one of these biotechs and make a big gain, or maybe I invest in 5 of them, knowing that one or two might be bad, but if a couple of them are good, then I'm going to make a really good return. All right. Okay. So what's the discount rate on this one? I'm going to go with a 9. It's risky. We're already seeing patents expire, so we're just going to go a little higher risk than a company that would be in really good shape. So let's do that. Now I'm going to look at a screen that you guys can't see, but just so I can get the numbers and we can fill in the sheet. All right, cash flow, an impressive 1.2 billion. All right, and the growth rate, again, this one's going to be similar to the one we just did. Where we're going to go with one growth rate for the first, I'm going to go with years 1 through 2. And this one's going to be years 3 through 4. This one's going to be 0. I think this one was about 15%. And we are going to move this one row higher. One row higher. Long-term growth, 0. Okay. All right. And the cash flows are really strong. How are we getting such a high discount? I think the outstanding shares is wrong. All right, no problem. We're going to fix that. Okay, so cash on the balance sheet is $2,930,000,000, and they only have a tiny bit amount of debt. Good job. Debt is not good. So shares outstanding, I am going to use a lookup that I have. So look at that. It's fairly priced based on the discounted cash flows, based on a forecast. Looking at that patent timeline, it gets it to fair price. Let's look at earnings per share. So earnings per share is going to be $8.06. And growth rate, go with 8. Yeah, this one with the whole the patent expiring, it takes a lot of value away. So got to be careful with these. If patents are going to be out there for 5, 6, 7 years. I mean, that's a lot of meat left on the bone. But with it being within 2 years, you have a milestone that's going to be a negative impact on the company. We have to be careful with these. It's really close to the end. So I would be very careful with it. All right. So let me add this guy to my model here. We'll put it in here. So I think DJ was asking about this one. So let's see if he has any other comments or questions. So insights made revenue drivers. Yep. Yeah. So I think if you look at the patent expiring on their main drug and that goes away, that's going to be a big loss, right? The other drugs I don't think are big enough to fill in the gap. I think they may see their revenue really go down substantially, and then over time they can start to grow it. So just be aware of that. And I think other investors will be afraid of it. Just be aware of that too. So thanks for asking about that, DJ. Good to see you. I think you had another one that we're going to hit. All right. So I think you want to look at TOST. All right. So it's a lot of talk around Zim and GSL. Yeah, those shipping stocks, man, they move fast. Thanks, Grumpy Grandpa. You reposted my stream. Thanks, man. Appreciate it. And all right, so let's move on to the next stock. The next one is going to be TOST. Toast. And I think these guys are like point of sale company, right? So Toast Inc. operates a cloud-based digital technology platform for the restaurant industry. Yeah. When you check out of a restaurant, I've noticed it, you have a Toast point of sale POS and good little system, email, or it'll email or text you a receipt. Cool. Looks good. They are a software infrastructure play in the payment space. $20.7 billion in market cap, revenues $5.86 billion, forward P 30.79. Analysts think there's a discount on it. Year to date, it's not doing all that great. 5-year, not good. Financials. Let's take a look at the quarterly. Growth looks good, 25%. Looks pretty darn good. Been fairly consistent on growing in the mid-20s. We look at the trailing 12 months. Free cash flow of 564. See, these margins I don't like. That represents like hardware companies, they have low margins because they're making a hardware device. They have to compete against other players. On the point of sale market, there's other players. These guys have to contend with other players. So that's one of the things that is an immediate like undesirable about this business is the low margins. They're going to make a small amount of profit and will try to make themselves as big as possible so they can get as much profit and cash flow from a high amount of volume that they can transact. But the barrier of entry isn't very high. There's a lot of point of sale companies. So 22 analysts cover it, and there is disagreement on what this thing ought to be worth. You go from 29 up to 60. They're going to continue to grow And the growth top line looks good, but it's just they don't make a lot of money. So their earnings per share is going to stay low. Based on that free cash flow, and let's see if they have any debt, just to see if there's any red flags there. They do not. They have mostly cash. Good. So this business to me would be worth, they have about 600 million in free cash flow. I'd probably go 15 times that free cash flow. It should be about 9 billion plus the cash on the balance sheet. They'd be worth about 11 billion. They're priced up at 20.7. So that's where I would land. I like businesses with better margins. This one here, they don't have a lot of room for error. If they have new costs come into their supply chain, takes out that precious profit, takes away that precious free cash flow. There's just not a lot of room. And competition will continue to come into their space because it's point of sale. There's a lot of point of sale players. There's very little barrier to keep people out or keep competitors out. So that one there would be a pass for me. It'd just be too expensive of a stock, not enough potential. This will, in my opinion, not be a $100 billion market cap company at some point. Just doesn't have the potential. So thanks for asking about that, DJ. I hope you found my analysis interesting. And regarding Toast, FISV having challenges, they have an opportunity to grab market share. Most definitely. It's just, it's a market share that I'm not sure I want. It's like, okay, you're going to have low margins and really have to slug it out with other competitors for this space. You know, maybe we can find, because as we were looking earlier at the heat map, let's go back there. This company is kind of operating here where it's kind of like the low margin zone. Okay. I'd rather operate here where we have, for example, Adobe has 90% gross margins, like 30% net margins. Intuit, 80% gross margins, 35% net profit margin, cash flow margins of 30%. And I can go on with those examples. These businesses there's a lot of profit left in these businesses, and these businesses are growing 10, 12% per year. So I'd rather be here, especially at a time when these are discounted, because there are stories that, hey, AI may disrupt software companies. I don't think it's going to, but the market has a story out there. And just remember, not too long ago, the market thought, hey, Google's done. OpenAI is going to take them out. Search is under threat. That's what they kept repeating on the business channels. Well, guess what? It didn't happen. All of a sudden, Google's up more than 100% in the last 7 months. And there were stories about Meta, so those stories on these software companies, I think, are going to be generally proven wrong. And therefore, those stocks are going to flourish going forward. That's where I'm spending my time. And I'd rather go after high margin businesses that could take my $20,000 of capital and turn it into $200,000. That's what I'm looking. I'm looking for that elevator ride up. So that's where I'm at with that. Thanks for bringing that up. Yeah, you're welcome, DJ. I really appreciate you coming to the live streams regularly and contributing and being a participant. Appreciate it. All right. I think I caught up. All right. So now that we're caught up, I can kind of go over some stocks that announced earnings. And if there's more requests out there, just keep them coming. If you have, if you're not a member and you want a stock requested like Bo did, just buy a super chat and I'm all over it. If you're a member, you put it in the chat, put in a stock symbol, and I'll cover it. All right. So let's get into DocuSign, which is not having a good evening. The stock is down 6.59. And this stock is a $14 billion market cap. The stock has not had a good year. It's had its moments. You can't barely see this, but it was really bid up during COVID. But if you look at the chart back here, you actually could have been making money if you bought at the right times. But this year, it just really has underperformed, and it's going to be even worse tomorrow. This is a good margin business. Forward P is 18.6. Analysts think there's a pretty good discount available on DocuSign. Looks like they loaded the information from their earnings announcement that was announced a couple hours ago. Good job, stock analysis. They grew by 8.42%. And you see that this is a decent growth rate, but it's not exciting. It's not 20. It's not 30. It's a pretty good sized business, and they do have tremendous profit, but they're kind of stuck in this good but not great growth mode. They generate a lot of cash. This is a cash cow. Margins, good profit, good free cash flow margin. So this one here is kind of in a zone of kind of not desirable, but not terrible. And it's not bringing in new investors because it's not growing fast enough. And it pretty much is a single product stock. Like they do digital signature capture, and that's it. So they don't have a new growth product, a new way of, growing that top line, having a bigger future. And that's what ails the stock. It's a stock that I own. I'm sitting on a gain because I bought it at the right time, but it is showing signs that it doesn't have a bright future ahead. We look at their forecast, it's going to consistently grow. So this is really accumulating cash. And if we look at the quarterly, consistent. And it's pretty much going to hit those numbers because it's digital capture. So a lot of businesses depend on this technology to get deals done, to get paperwork signed, to do certain tasks that pretty much they need this. So the earnings per share is going to grow nicely. So this is potentially a stock that's going to have modest gains going forward. But buying at the right times is critical. You cannot buy this stock, when it's bid up. It has been bid up recently, like in the last 18 months. So buying this stock at the right levels is critical. See how it goes up, down, up, down. Right now, it's kind of depressed. So it's not a bad time to look at it, but I'm not buying any more shares. I have a $30,000 position in it, and that's enough. I don't need any more. Tomorrow, it won't be 30,000 anymore. It'll be somewhere in the 20s. When we look at the valuation, I've already updated the valuation on DocuSign. It's nicely discounted, but there are other software stocks really nicely discounted, right? So it'll always just show up as, man, look at all the money they have and look at all the money they're making. Great. They can buy back shares so they can make their shares more scarce. They should do that because they have a lot of cash. And I think there'll be modest gains ahead. Buying at the right time is key for DocuSign. Where I was going was this week we had a good number of earnings within the software space. There's a lot to choose from. You have Path had a terrific day. We can go to that one next. CRM had a decent day. And let's look at Path. Path is it deserves that appreciation. And a couple of days ago, we looked at their growth rate. And I was commenting that they kind of hit a slow zone here of going from growing 10%, slowing down, I guess picking up a little faster. And the quarter before this announcement, they really stepped it up. And I commented that if they could show an additional acceleration, the stock would really work. It'd really rally. And there it is. because investors are excited that, hey, these guys are really beginning to grow. And when you look at UiPath, this is truly an AI company. It's not like a legacy software company that all of a sudden, since AI is the coolest thing that you could do now, oh, we're AI, everything. No, these guys were born in AI. They do true agentic AI, machine learning. If you study their website, these guys are truly an AI software company. That's what they do. That's the only thing they do. They don't do anything else. And they're under a $10 billion market cap. P ratio for 2026 is 25.6. They're growing high teens and looks like they're accelerating, which is good. You look at here, at times the market just notices them. Boom. Look at that. They went right back to that number. Amazing. Now they need to keep it. They need to stay at that level. So these guys, and you make a good point, DJ. So if a company sets up like workflows with Path software, they're going to be paying Path for 5 years, 10 years, 20 years. It's a very good reoccurring business for them. So that looks really exciting. And but this stock is small, so you can understand this volatility. And we'll see how it trades tomorrow. It looks like it's not enough of a decline to comment there, but this is a stock that I'm watching. Let me show you my valuation. When we look at their forecast, and I think their forecast is going to have to be updated by analysts because they really surprised the street. The quarter they just announced is here. They're supposed to do 11.45. So if they outperform this, it'll be interesting. And then here's a 4% growth quarter. That's weird. That's kind of a yellow red flag. Like, wait, you're not going to grow in roughly 3 quarters? Why not? Why would you not grow? They are going to slow down according to their forecast. So if they can just outgrow what is being expected, their stock's going to keep flourishing. So that looks it looks like they're having a good night. It's a small cap. I like what I saw. If they can keep performing, I like this stock because it's very unique. I don't know if a lot of businesses do what they do. And if they start establishing a really strong name for themselves, they're going to get a lot more business. Looks like Trader Pratt is on. Good to see you, man. Thanks for joining. Hope your stream went well earlier. On volatile days like this, these short-term traders like Pratt, those are the guys that are making all the money. All right, so Path, not a big discount. And they're not quite big enough. If they can continue to accelerate their growth, they're going to do fine. But it just doesn't have enough there for me to sink my teeth into. And what doesn't help is it went up 24%. I think if I would have looked at the stock 24 hours ago and I had this valuation, which I wouldn't have had because they hadn't released the numbers, it wouldn't be this high. So go UiPath. They deserve to celebrate today. I'm sure the employees that own the stock are very happy. Congratulations. They're doing really well. But this is in the software space. And then you have other companies. Let's take a look at CRM from here. CRM had a good earnings. It was a good earnings. And they showed how they're growing. And before I move off Path, looks like Anderson's got a comment. So Path is also completing a transition from single license to subscription, which will generate recurring revenue. Yeah. I think that, I could see that. If they were licensing, like you sell administrative licenses and they can create as many workflows as they see fit, that's advantageous to the customer. Where if you instead are licensing, hey, it's like, we're gonna charge you for as many workflows as you're creating based on that volume. That might be more advantageous. So it's a good idea for them to do that. All right. So Salesforce beaten down. I mean, this is not pretty, man. Not pretty at all. This is a very reputable business. They've been around for a while. They have a pretty decent market cap. They have a forward P of 19. Analysts think, man, what's the market doing? This thing's worth 36% more than its current stock price. And they came in with some solid growth. The growth was solid. 8.63%. It's a big business. Keep in mind, it's a $40 billion a year business. You grow by 9%, you're growing by nearly $3.6 billion of top line dollar revenue. That's a very good growth rate. And when you look at how profitable is Salesforce, they're very profitable. And they crank out cash. Look at that. This is like, man, beautiful cash flow. And look at these consistent numbers. When I see numbers like this, it instills confidence. I expect they're going to keep cranking out this cash. Okay. Margins, beautiful margins. Profit. Everything's there. This company is like solid. It's like a Toyota Tacoma. It's solid. Things are going to run for 25 years. You can put 300,000 miles on it, especially those old Tacomas. Man, just tough. Salesforce stock is really built to last. And when you look at the forecast, it's expected this thing's just going to keep growing. They also see a little acceleration. So CRM, I think, is some smart money starting to buy. And I hope they continue to buy. In fact, let's do a couple of things. Let's see if AI can serve us well here. What super investors own I know where I can find the data, but let's see if Gemini can find the data. Look at that. Woohoo. Well, let's see here. Super investors who have held. Okay. Gemini, you're not passing the exam. I didn't ask you who held, who owns. Okay. So Gemini didn't get it done. It's all right, Gemini. I'll come back to you in a little bit. But I do know where I can find it. Where I can find the answer to my question. There's this website that will put every ad in the universe in front of us. So it'll make it nice and annoying for us to try to get through the maze of ads, but the information is vital for this conclusion. So we've got some super investors, famous investors invested in this. Who are investors that I'm familiar with? Vinal, he bought it. This guy's legit. He's a Swiss investor. He's invested in things like Meta. He's really good. And he bought shares. The other guys I'm not familiar with, but they're considered famous super investors. So there they are. This guy, let's look at his portfolio really quick. So he found Carvana when Carvana was nothing. It was so priced so low, and he killed the market. He just did so well because he bought that one. Meta, I don't know why he's invested in this. Wix, he's losing his shirt there. Interactive Brokers has been a success story. Pinduoduo. So this guy knows what he's doing. Google, big winner. So he bought CRM. See, this is kind of a sign that, hey, you know what? CRM is beginning to get noticed. So that's a good sign. Very good sign. So CRM is a stock that I think is going to go places. So I showed you what analysts are thinking about CRM. Let me show you what I've come up with in my valuation of Salesforce. 40% discount. If we can get this thing to rally higher, it's got a lot of gas in the tank. It could drive us coast to coast because it's got really good fundamentals. It's got excellent bones. And once it starts attracting good investment, it's like, spreading honey on something. It's going to attract a lot of bees and bears, and everybody wants to lick that honey. So I think Salesforce has had a good day, and little by little, I think it's being recognized. I think it's a really good opportunity. It has great fundamentals, and I think it's going to end up being a nice stock for the next 2 years, maybe double in stock price because the fundamentals are there. And I like doing this. This is why I invest in stocks. This is how I felt about Netflix, more than doubled my money. This is how I felt like about Meta before I went up 600%. This is how I felt about Google a year ago. Google's up 130%. These fundamentals are not made up. This company is solid. So I enjoy investing because you go through a lot of stocks and then you see what really good looks like. And in some cases, I'm not going to call Salesforce great, but you can look at Google and that's what great looks like. You can look at Nvidia. That's what great looks like. That's excellent. You want to see a great player, in basketball, you look at, I guess, clips of Michael Jordan or Kobe Bryant, LeBron James. Yeah, that's what great looks like. And Salesforce is probably one rung below that, but man, it's worth a lot more than what it's currently trading. So that was Salesforce. That happened this week. So we covered Path. Congratulations to Path. If you own Path software, congratulations. I'm sure you're happy about that. Just feeling good about it. You should. If you own Snowflake, not feeling good at all. And this stock here, they're a data platform company within the software space. What they do is they enable companies that have these big systems, applications, workloads, and maybe they have them spit out a lot of data. Snowflake will be a great place for you to bring your data into a common place, and then you do reporting. You can do all kinds of things. And Snowflake came with a lot of fanfare. When it got introduced and it IPO'd, had a high stock price. It's come down. A lot of IPOs do. So it's not just Snowflake that had that experience. Over the 1 year, it was really moving higher. So it was looking good. When I examined it, I thought it was expensive, high PE. And it's not the first time I've said this, said it a year ago. It just looked expensive. Has good growth rate, undeniably good growth. Roger that. But when we get down to, all right, you're selling a lot. Do you make a lot? That's where things become a little less convincing. You have a decent margin rate, very good, 67, but then you lose a lot of money and you're already pretty good size. So why are you losing so much money? Your free cash flow margin isn't very high compared to others like Salesforce and other software companies. So when it's all said and done, it just looked expensive using my model. Analysts that just depend on earnings per share. Today, they're saying it's 14% discounted. These guys are going to keep growing. And I think that's fine. They're going to keep growing their top line. But the top line is one thing. How much is making it down to the profit and the free cash flow line? That's what we have to also keep an eye on. And when I do that and I put it into a valuation model, it's just a really expensive stock. And I was pointing to this going, yeah, this looks really expensive. And voila, we had a day like today. And I think the market, the other thing that I would point out to is that Snow announced their earnings. And if you read the earnings, they were good earnings, very good top line growth. And, but it just shows that this stock's too expensive. There's better alternatives within software to make a sound investment and make money. So Snowflake had a lot of struggles today. We'll see if it's going to be starting a downward trend or if it's going to bounce back. We shall see. All right. So again, good to see you, Trader Prad. And we've got a comment on Space Mobile. Congratulations. All right. So where do we go from here? We got lots of stocks to look at. I think we wanted to look at Rubrik. I think I missed that one. And then we wanted to look at NBIS and CoreWeave. Sorry that I maybe missed on those guys, but we're back. All right. Let's get back on track here. So Rubrik looks like they're trading higher. Wow, look at that. That is really going places. Now, it had started a downward trend, and now it's going to pop up to 82. So it's going to get up here. And it's a smaller cap. Now, these guys, Rubrik provides data security solutions to individuals and businesses worldwide. Data protection, unstructured data protection, cloud data protection. Okay. All right. So security, 14 billion in market cap, strong buy, big discount. They're growing nicely. They did have kind of a slow year in 24. High growth. And we'll have to open up their earnings to see what their growth rate was. Maybe that's going to be here. Nope, it's not provided there. So we have 17 analysts covering it. And all analysts think, this thing is either worth its current stock price or it's higher. And when we look at the forecast, the growth is going to slow down. You see the slowdown there from a percentage standpoint. So it's not going to grow at these go-go rates, or maybe it will. If it does, the stock's going to rally for a while. So this go around, they announced this quarter, they should have grown at 38%. They impressed Wall Street, and the stock is up 17%. Overall, do I have a valuation on Rubrik? So I had it valued 13% too high, and I couldn't value it on earnings per share because they lose money. And I'm growing it at 30%, which is very fair. And they're going to start slowing down. So this might be a little too optimistic. But that's where I'm at with Rubrik. When you look at this space here within cybersecurity, there's some good deals. There's other companies that are valued better and have a more solid track record. This one here is just a little too risky, lesser known, and we'll see how it goes. We'll see how it goes long term. And they had a good earnings, and we'll see how it performs over the next couple weeks. Overall, it's still up 38%. It's still a nice. No, this is a new issuance, from 2024. So they've been public about a year and a half. All right, go Rubrik. This would not be an investment I'd make. There's just too many good options in cyber security to take a chance on these guys. It's just going to be too wild of a ride. DJ HPE announced after hours. It's slumping, huh? Yeah, down 9. So HPE is kind of a legacy company, and, you know, there's not a lot of excitement there, and they're not growing. They kinda have cash cow products, but actually they grew well here. So what's been happening lately? The growth is there. So why is the market not liking their stock? It's not like the stock's really bid up. It's done well for the 5-year. Probably selling a lot of cloud services and stuff. Interesting. It's not a stock that I really track. It's kind of an old school company, and they have a lot of debt, is according to that comment. Yeah, they have some debt. Just every time I value it, I'm like, I'd rather own Google. I'd rather own Amazon. I'd rather own, a company that has a grasp on the future, where Hewlett Packard has a grasp on how we used to do computing, how we used to do all on premises compute. We're not there anymore. It's those days are gone. And I think the future is owned by Amazon, Google, those types of companies that do cloud infrastructure. So, all right. So I think we want to look at Nebius. And these companies, speaking of cloud computing, so Nebius is a really interesting stock. They do cloud infrastructure, and they started, I believe, in the crypto mining space, and then they moved over to handle workloads for the AI build out. And they are going to grow. But if you see any kind of slowdown, these guys are going to be the first ones to be in the house of pain. $26 billion market cap. I think they've signed some good deals with some bigger companies at least a month or two ago. That helped them. When we look at their growth, hyper growth, but they're growing on tiny numbers. This is where they cut over. They used to have a different business, and then they go, oh, I think we want to do cloud infrastructure instead. Okay, there you go. Their growth is good, very good. They're burning a lot of cash. They're having to put a lot of capital in that data center. It's expensive. So they're going to be burning cash for a while. When you look at the margins they have on their business, that's a very good margin, 59% gross margin. But you can see the operating margin. How do you go? Oh, I know how they do this. So their operating margin is really terrible, but then profit margin is positive because they probably sold some of their crypto and they took a big gain. So that's what probably happened there. You see the free cash flow. So this is just risky. If they get caught with, they spend a lot of money in the data center and then the data center is idle, whew, you're in the pain zone. It's going to get really, really ugly. They don't have much debt because they could pay it all off. So that's good. Stay that way. Don't get into the debt, a high debt level, because then you'll really be risky. So yeah, I invest in the same business that these guys are in. I invest in Google, which has the same business, and Amazon, except those businesses are like triple A rated. Those are the best businesses one can own. They're going to be around in 20 years. They are not going anywhere. Nebius, we can have a few turns that are negative turns for Nebius, and they're going to be in a world of hurt. And the same goes for CoreWeave. Same comments for CoreWeave. It's a business that, near term has been doing great, but long term could really be nasty. I mean, look at these. The sell off was pretty intense. It's still positive if you've owned it for a year, but the sell off was pretty intense. It got up to 183, down to 85. So same type of business, same scenario. They used to be a crypto miner. They moved over to cloud infrastructure to take advantage of the amount of interest in doing AI work through these hyperscalers. So we'll see where these land. We'll see if they make it, if they make lots of money for investors. I will stick to Google and Amazon. Thank you very much. All right. Update on the game 3-3. The Lions they just scored a touchdown. So update, Lions scored a touchdown. It is now 9-3 Lions leading toward the end of the first quarter. And the Lions will likely kick a field goal to make it 10-3. We'll see what happens. Atari Kid, good to see you, man. Yeah, I've been adding Amazon. That's been where a lot of my capital's been going. Amazon is a stock that I want to own for the next 5 years for sure. All right. Well, I'll tell you what, guys. I need a 5-minute break. I've been going for an hour and 51 minutes. And then I'm going to be back in about 5 minutes. I'm going to get myself something to drink and I will be back. Hang with me. I'll take a 5-minute break and then come back. Hey guys, I'm back. Thanks for hanging with me. And let me see if there's any new comments here. All right, there are some new comments. So somebody talked about Amazon. That was interesting. All right, Stingray Rasta. Let's talk a little UMAC. Been holding for about a year. Figured drones are here to stay. They need parts made in the USA. All right, cool. Let's take a look. Unusual machines. Cool. We're all over it. 1 second. It's GMAB. GMAB. Put it in the chat. All right. So good to see you, Michael. All right. Back on my task. UMAC. Let's take a look at UMAC. Unusual Machines engages in the commercial drone industry. The company offers small drones and the essential components. It distributes their products through B2B sale, e-commerce site, retail channel. Okay. So they're classified in technology. All right. And all right, cool. Got it. So small cap, 403 million. Revenue, 8.3 million. So you're paying up for the stock, right? You're paying about close to 50 times revenue for the company. That's an expensive ratio. If you have a growth stock, maybe you pay 20, 30 times sales to get to the market cap, but this is pretty high. And it's a small cap. So we have a strong buy with a big discount. Year to date, it's down 35%. 1 year, down a little bit. It's really worked over the 5 year, but you had to buy it when it was really low priced, $1.65. They IPO'd and they didn't get a lot of attention. And now they definitely got attention. It's up 173%. Okay, so they're doing about $2 million, $2,130,000 in revenue. It is growth. It's just really small. Okay. They don't have any cash flow. They've been burning cash. Gross margins are 32, not very high. And they're losing money on their revenue. They're not very big, so they're losing a lot of money. Let's take a look at their financials directly and try to make sense of what they're doing, see what they're planning on doing with the business, why they lose so much money. So okay, so trying to get to their financials and just to try to try to get an understanding of how expenses are coming in, what are they spending money on. Okay, so starting with the balance sheet, they've got about about $80 billion, 80 million, excuse me, $80 million of cash. Okay. So how are they that small and they have that kind of cash level? That's interesting. So they don't have any debt. That's very good. Having this amount of cash is important because it's a small business. They're trying to grow their business. They're going to need some cash. Like they invested in a new facility. I noticed one of their press releases. They're going to need that cash. It's good that they have it. So revenues. Revenues are, this is the quarter, and then here's the 9 months. So here's our gross margin. So operations 636. Okay. R&D, sales and marketing. General and administrative. How come it's so high? 4.7 million. Huh. General and administrative. That's a pretty big number. If they're not very big. They're doing $2 million. And they're spending a lot on general administrative. Okay. It'd be one thing if they were spending it on research and development because they're creating new products. But this one's a little less comfortable to accept. Okay. And you see, like in 24, it wasn't as high. In 24, they lost some money, but not as much. Over the 9 months, they've lost $15 million. And in the quarter, they lost almost $5 million. So unrealized gain in short-term investments. Unrealized gain. Yeah. I don't know why they're putting that on their financial. If it's unrealized, then just leave it on your balance sheet. They're trying to make their number look better because they did have a loss and then they can have an unrealized gain. But what if this investment goes down in value? Then you're going to have to restate the asset and take a negative number against your income statement. Okay, so those are the numbers. This number is concerning. Like, why are they spending so much money here? You know, what's cool about these little companies is if you go on their earnings call, chances are you'll be able to ask a question because they're really small. And I would ask, well, politely try to be crafty on how you ask a question of why they're spending so much money on general and administrative, just to get a good explanation. Maybe they have a really good explanation. So I would definitely put that. If you go to their earnings call, ask that question. That's right. Now I remember. Yeah, wasn't it one of the sons of Donald Trump joined their board and then the stock just went through the roof? Okay. Yeah. Okay, cash flow. So they took a loss for the 9 months. They're issuing out a lot of stock. I wonder who got that stock. Probably the Trumps, right? One of the Trumps probably got a lot of stock. And then this unrealized gain, you see how it's not a cash item. It's coming back. Okay. So overall, they're burning a lot of cash. Man. Now they did have $80 million. So they got at least 6-7 years of cash, to go. So if they could start growing, they get up to like a $25-50 million number in revenue. I think things will be okay. So this is the IPO money. Okay. That was back here. Then they issued out. So they issued out more shares. While the stock was really going up, they issued out a lot of shares. And shazam, that's how they got the 80 million on the balance sheet. So this is this business is not going to value very well because it's so small. But now we kind of see how we can follow the numbers, right? These numbers, the cash on the balance sheet came from issuing new stock. When one of the Trumps became a board member, the stock went through the roof. So they took advantage of that. They issued out stock and put a lot of cash on the balance sheet. That was probably a wise move. So what is this business worth, right? 3 analysts cover it. They think this year it's going to be a $21 million business. They're not going to make money, but they're not going to lose a ton of money. And they'll be a $50 million business. So at their current valuation, if they end up being a $52 million business, then that means you'd be paying eight times revenue. It's not bad. Okay. And at 21, you'd be paying 19 times revenue. That's not bad. Okay. Looking at the quarterly, this quarter is going to grow nicely, 60. So the growth looks really good. They don't cash flow, so it's hard to value the company on cash. If you net out the cash on the balance sheet, the market cap in my mind is like 320. And I think you got to follow the growth. And eventually, I'd be curious, what's your exit strategy? At what point do you think you would want to, is this a stock you could see yourself owning if it just keeps growing and you just want to let it ride higher? For the most part, it's kind of held. I think this is when one of the Trumps became a board member and it went through the roof. It went from 280 to $18 and it's settled down a bit. But for the most part, I mean, it's still trading much higher. I'm not going to be able to value it to get to 400 million. So you're going to have to make decisions along the lines of, if you think they're going to hit the forecast and they start growing about the rates that they're growing, I think the stock's going to rally higher. But you'll have to make those decisions on growth. And eventually, maybe 2 years down the road, or I don't know when, at what point do you want to exit the stock? That one's hard because you don't want to get off, too early, but this one also could be a real mess. They don't have a lot of revenue. It's $8 million of revenue. If they surprise us to the negative, like, they're not growing the way that we expected, the stock's going to be under some pressure. But maybe they get a contract or two from the government now that they have connections. I don't know. Maybe they will. So this one, I can't do a model because they don't have any cash flow or profits. And I think I've done as much as I can. Interesting company. Good luck with it. I think you've been in it. I hope you're making money on it. And your theory or your big picture, I agree with. Like, drones are growing. I'm not in a drone company because their fundamentals are not attractive enough. They don't make a lot of money. Their margins aren't very high. So I don't get into them. But they've been doing really well. Other drone companies and aerospace and defense companies have been doing quite well. All right. Good to see you, Stingray Rasta. Thanks for tuning in. All right. So we went over UMAC. That is stock number 10. All right. So, where are there good places to invest for next year? Let's keep talking about that. So, we talked about software, how there's probably going to be a couple of honey holes in this area. We talked about CRM, Path had a good day. I think Intuit's a terrific company. I've been buying into that. Adobe announces next week. That might be, I think Adobe might be helped by the good news this week on software. We've had, I don't know, about 8 companies, software companies announced this week. And I would say we had a couple of really good announcements that took those stocks higher. Had a couple of okay announcements and those stocks were okay. A couple of bad ones. But in general, I would say software companies have come in and performed better. And Adobe obviously is a software company. They're announcing next week, a week from yesterday. It'll be Wednesday of next week. And this stock is beaten down. It's really down. So what's interesting is the stock's been beaten down while the company's been growing. So it's growing. It's dealing with a perception that AI is going to put Adobe out of business, but it hasn't negatively impacted the business yet. In fact, their growth is pretty steady, 10.7. Their profitability is fairly outrageous. Gross margins 89%, profit margin of 30%, free cash flow margin of 41%. Those are terrific numbers, awesome numbers. So, where's this stock going to go next week? I bought shares today, thinking that the good news around software is probably telling me that Adobe's probably going to announce as expected, and it's probably going to rally higher. So as I look at the analyst predictions here, 21 analysts are covering it. They think it's discounted as well. And let's look at the forecast numbers. So for the quarter that they're going to announce, the quarter that ends December 1st, I believe. This is the quarter they're going to announce. They're supposed to come in with 11% growth, $5.50 of profit, which would be a 45% increase. That's really good growth. That's terrific profit. And look at here. And then it's going to grow by 39, 48. These numbers look terrific. If they could hit this forecast, there's only one direction the stock could go, up, especially since it's just been beaten down to a very low number. When we look at their balance sheet, they have a little bit of debt. They have $6 billion of cash, $6.66 billion of debt. So they have a small amount of debt, no problem. No red flag to report there. That looks good. So going into next week, I think Adobe's going to have a good week. I could be surprised, and it could be like, uh-oh, they didn't hit that forecast number. They had some negative news. But if they already know that, they would have probably pre-announced it. And I don't think that's the case. So I think I'm liking where Adobe's at. We'll see how close or how far I am with Adobe. But enough about Adobe. Let's talk about Cisco. Because Atari Kid 7424 wants to talk a little Cisco. This is a legendary company. This is a company that built the internet, or at least was one of the key companies that helped build the internet. Thank you very much for the super chat. And thank you, Stingray Rasta, for the super chat. Thank you, sir. Atari Kid. Cisco is a solid company. Their stock's been going up 31%. Over the 1 year, 30%. This is a pretty good looking stock. 76%. You get paid a 2% dividend. You had about 12 points in that dividend to that overall performance, and we are good. It's been a good performer, and it's really done it all over the last year and a half. So good job, Cisco. $306 billion of market cap. The PE for 2026 is nice and low at 18.5. And analysts think there's still some more room to go higher. These guys announced on November 12th. What happened November 12th? Well, this happened November 12th. The stock went up. Well, that's good. That's good for investors that owned it. But it's not good for investors like me that don't own it, that maybe are like, hey, Cisco looks pretty good. Let's keep going. Maybe there's still a lot of meat left in the bone. So when we look at Cisco, this is an established business, big business, $56.6 billion in annual revenue for the last full year. Looking at the quarter, they're growing by 7.5%. That's a decent growth rate for a big company. Last 4 quarters, solid. This means that customers are buying Cisco products. Looks good. They were kind of on a skid back here. You see that negative contraction back here. Trailing 12 months looks good. Let's take a look at their margins, see how profitable Cisco is. So they're making some cash. Look at that cash flow. Beautiful. Nice, consistent level of cash flow. Looks like growing. I am feeling comfortable, confident about their cash flow. Margins 65%. And they're in the 60s because Cisco actually makes a physical product, the Cisco router or other products they make. They have to put materials and have to manufacture it and so forth. They have a bill of material involved. So having said that, they start with a lower gross margin, but they ended up with a nice profit margin of 17.9% and a nice free cash flow yield of 22%. Those numbers look solid. Okay, so we got solid numbers from a very reputable company. Let's take a look at the forecast. What is Cisco supposed to do going forward? 16 analysts cover Cisco, and for the most part, a lot of respect being paid. We're going from $63 to $100 price targets. On average, 8.6% discount. And when we look at the forecast, the full year, we just completed this year. We're operating in this year here. Revenue is supposed to grow at 9%. And each year there's going to be growth. This looks like a very good forecast. And it's being forecasted 5 years out. Very good. Growth. Very good. Their profit is jumping up, and it's going to stay higher. That looks really good. Their PE ratio is coming down. I think the stock's going to keep working. I think this stock's going to trade 20 PE because it's growing. It's got a really nice kind of 1.5 year rally. Other investors are like, hey, this is a good stock. They're performing well. They're growing. Infrastructure is getting built out. It's not like, oh, they're building less data centers. No, they're building more data centers. You've seen me on this stream using Gemini. More people are using AI. Well, we're going to need bigger networks, faster networks. Cisco's going to sell more equipment, more solutions, and so forth. So I think this is setting up for the stock to have a good future. Now, I have performed valuations on Cisco, but I think I'm going to need to update a number or two. Let's take a look at my valuation of Cisco and see what I've come up with as an intrinsic value for Cisco based on their cash flows, based on their earnings per share. Let's make sure that I've got. So I completed this work when they announced their earnings. Now, one number that I'm going to change, because now it's pretty much a foregone conclusion that interest rates are dropping. This is correct. This is correct. So that's fine. So Cisco comes with about a 15% discount. Analysts were discounting the stock by close to 9%. I'm at 15. If Cisco could drop and give me a 25% discount, I might buy into the stock, but at 15, that's just not enough. Not enough. Feels a little bit like I missed Cisco. Buying in Cisco was great a year and a half ago, a year ago. But you know what? I missed this one. That's okay. Hopefully some of you own it and have made money on it. 15% discount would probably be enough to hold the stock, but not start a new position. You're waiting for a pullback to 72. I'm with you. I'd be waiting for a pullback. If we can get a pullback, to 72, that would get us about a 25% discount. So we're on the same page there. Good stock. Stock's price has gone up, so there's not a big discount. And their next earnings isn't for another 2.5 months. So we're going to be waiting a while before we get some new financials. But good job, Cisco. This is a very well-known company. Glad to see some of the businesses that built the internet do well, and these guys are getting it done. The market cap is 307 billion. Awesome. So good job, Cisco. All right. Thanks again, Atari Kid. Now let's move on to HIMS. So Stingray Rasta sponsoring the next super chat. Thoughts on HIMS? I'm down 11%, but would like to hold on to one of these emerging med companies for the long run. Got burned by CVS. Okay, let's take a look. So I do have a valuation on HIMS. I might have to update it, but we're going to go all the way with HIMS. I'm familiar with this business, so let's get into HIMS. All right, so HIMS they are, the way that I see them, right, my interpretation is they've picked like 4 different categories of healthcare products. These are very popular categories: weight loss, sexual health, hair growth, skincare, boost testosterone. And these are conditions that a lot of people would like to improve in themselves. And HIMS provides weight loss has been a really good product for them. And for a while, there wasn't enough of the drugs that were coming out from Novo Nordisk and Eli Lilly. There was scarcity there. There wasn't enough to go around. So the FDA, under those conditions, they allow other companies to basically use the formulation that company has a patent for and distribute it out to the public, because they don't want people going without medicines that they want or they need. So HIMS was able to operate, and they're considered a compounder because they get these compounds, they mix them, they sell them to the public. Now you're allowed, if you do 1-to-1 compound mixes, you're allowed to do that. And right now, I think Novo Nordisk is suing HIMS and saying, hey, you're not supposed to sell weight loss anymore, and you're infringing on our patent. We'll see how that goes and who wins that court case. But overall, I think of HIMS as a really good marketing company. They've picked out certain categories that are really good sellers, and they're doing a good job getting their name out there, getting people to buy the products, establish an account with HIMS, and then HIMS is doing well. growing their business. So that's their business in a nutshell. Now let's take a look at their fundamentals and see what the business looks like when we lift the hood and look at what's going on with this business. So the stock is up 24%, but you see the volatility. This is still fairly a small company, 9.11, but they were a lot smaller before. Okay, they were down here, and investors that got in early did really well. Even with the pullbacks we've had, right? Rear view mirror investing. Boy, if you bought back in 23, look where you'd be. But it has been a good run for investors that got in early. Now it's been a little bit of a roller coaster. We've had a pretty good pullback starting in October 15th, and we haven't quite made it back to where the stock was before. It's seen some adversity. November 3rd was their last earnings, and November 3rd was here. No, it was before that. So you can see what happened. After the earnings, the stock really came down. So I wonder what was in there that scared away investors. $2.2 billion in revenue. P ratio for 2026 is 68. This is a growth stock. You got growth. And you got, I think what scared away investors was they were growing really incredibly here. And they started to slow down a little bit. But it's still good growth. 49% is excellent. All right. Now, when we look at the trailing 12 months, we're going to look at the same ratios I look at. Free cash flow. They generate free cash flow. Very good. 133 million. Looks 34. It's almost 34. Gross margins are very high because they're selling these specific drugs. They purposely pick these drugs they feel they can market and make money. Now their selling cost is really high. So even though the gross margin is high, the selling cost is really high. So they end up with a small operating margin and a small profit margin and a small free cash flow margin. And you can see that their margins have been contracting on the cash flow side. And to some extent, the profit did come down quite a bit in Q3. So am I looking at the quarterly? No, I'm looking at trailing 12 months. Good. That's what I wanted to look at. So I think this might be on the minds of the investor is, why are your profits dropping so quickly? What's going on? Like, why are you spending so much money? And we'll look at the actual financial statements that HIMS produced. We'll look at that in a little bit. All right. So forecast, what's going to happen? 9 analysts cover HIMS. One analyst is very, very high on the stock at 85. One analyst is like it's worth 30. So when you blend all those together, they're on average 11% discount. So as we look at the forecast, we are operating in this year 25. And for 26, they're going to grow at 18%, 19%, and then slow down. I don't know why they'd slow down. I'm not convinced they would slow down that much. I actually think they'll probably exceed this revenue and this revenue. They're growing their profits. That's good. And their P ratio is coming down. It should come down a little faster because if you're just growing at 20%, this would be too expensive of a P ratio. Because you can find a lot of healthcare companies growing at 18, 19%. And their P ratios are like 15, 20. So why would HIMS be so high? So they got to keep growing. All right. So let's take a look at their financials. I want to look at their financials and kind of see a little more detail. And let me just kind of get straight to what I need. So one thing that I want to put to rest is so is Hims being sued by Novo Nordisk? No, Hims and Hers are not currently being sued by Novo Nordisk, though Novo Nordisk has accused the company of intellectual property violations, deceptive marketing regarding its compounding products. Okay, so that risk is far lower than I thought. Good to know. Let's get back to their financials. Oh, unusual machines. So this is what was announced previously. So let's take a look at the press release, the shareholder letter, and the 10Q. All right. So revenue was up 49%. That's very good. They have a subscription model, and that went up 21%. That's a good idea. That way they have like stickiness, right? You have customers coming back. Okay, that's a good idea. So they do everything, they do most things online here. Their growth is good online. Okay, so 49% growth. Fourth quarter, they expect to go from 605 to 625 in the fourth quarter. And what was last year's fourth quarter number? So last year they're at 481. So that would be growth of about 120 million. And that would be about high 20s percent growth rate. So that might be part of the heartburn that investors are feeling, that they're going from 49% growth rate to high 20s. It's still a good growth rate, but it's just a lot lower than 49. So, all right. And then full year, okay, that's fine. So the slowdown in the growth rate might be on investors' minds. Then we have balance sheet looks okay. They don't have too much debt. Okay. All right. So this is important here. I went too fast here. Sorry about that. Okay. So we have for the quarter, we had revenue, the cost of revenue. So they have got good margin there. Here's the marketing cost I was talking about earlier. They have to do a lot of marketing because they need to get in front of eyeballs to get people to buy their product. That's where most of their cost is. And once you add all that up, right, you have the operations team, technology. They use a lot of technology, and general and administrative. Okay. And once we add all that up, we are left with a small operating profit. They had a couple of adjustments. So this is where a lot of the money is kind of consumed by these expenses. Okay. All right. And they're in a type of business where they don't have the luxury of, hey, we have this patent to treat this one disease or illness, and doctors are always prescribing it because it works, right? And it's the only drug that's available that does that, and it's protected by patents. They don't have that luxury. They have to go earn the next customer for hair loss, the next customer for weight loss, the next customer for this and that. And then those customers might seek other options for their healthcare. They might just go back to the doctor and have them prescribe something. So they have that type of stress on their on their revenue line. Looking at their cash flow. So net income is there. So I don't see anything funky. Yeah, everything's fine there. This is 9 months. So they are putting a lot of money into the business, a lot more than last year. You see how last year CapEx, which is also called purchases of property, equipment, and intangible assets, it was only 17 million. This year, they put 166 million. Well, are they like building a new platform? They implementing AI? What are they doing with that money? That's a lot of money. And what it does is it reduces your free cash flow. Free cash flow is your cash from operations minus capital expense. The reason Meta sold off so harshly is this number was too high. So Meta came out and said, all right, we're not going to spend that much more money, and the stock went up today. You may have noticed that. So this number here may have also caused the investor community to be like a little put off by, wait a second, you're putting too much money back into the business. Why are you burning so much cash? So these numbers look a little light. The revenue decrease looked a little light. Okay, so we went over that. I think we got a good understanding of the business. Now let's get into my valuation and update it because it needs to be updated. It is got some outdated information. So my valuation of HIMS as of December 4th. So this is too high. I think we should get down to, without the lawsuit, we're good. Okay. So they're growing better than that. Go with 25 there. 4 is fine there. And on the trailing 12 months free cash flow, what did we have there? What did we have? We had 133. Now let me take you through my thought process there, because sometimes companies will have a drop in cash flow. I want you to kind of see this with me. What we want to do is we want to try to predict the future, which is hard. And you have this company free cash flow for the full year 2024 was 209 million. Year before that was 56. So the jump up was very, very impressive, which probably led to this stock really jumping up. Now, when we look at the the trailing 12 months, and this takes trailing 12 months for the last 8 quarters, the free cash flow has been, it kind of went up and then it came back down. Okay. So I'm going to go with 200 million, excuse me. And the reason for it is I'm expecting that CapEx that they put in the business, these are like one-time, investments. Like, hey, we're going to build out a new data center so we can have a faster, website. That's probably what happened. So I want to kind of make a decision that I want to go with a more realistic number that I'm expecting they're going to bounce back to. That'd be 200 million, growth at 25%. And the future, I'm growing the future cash flows, and that's why that number jumps up to 250. All right, so next number I need is my cash. So we're going to look at the balance sheet, and we're going to look at cash and debt. So cash looks good. That's on the button. This one's on the button. So if we compare using my estimate that I think they're going to bounce back to, we have an 18% discount. Now let's look at earnings per share. And the forecast for earnings per share for 2026 is 66 cents. So that one needed to be updated. So they brought down their earnings per share. It used to be higher. Okay. And the P ratio 36. That's a little high. But we'll go 32. And they're growing about 20. That's fine. So the stock's fairly priced. There's no big opportunity to see a discounted stock. The stock price has seen, in general, a rise over the year and a very big rise over the 5-year. The keys to seeing this stock grow is to see this stock go up and appreciate is going to be all over revenue growth, and they have to control their CapEx. You saw even the great Meta, which is worth more than $1 trillion. They spent too much CapEx, and investors took them out behind the woodshed and beat them. These guys, they can't spend too much CapEx. They have to adjust that and grow. Don't spend too much on CapEx, and try to expand your profitability a bit. If they can do that, the stock's going to work. If they cannot grow faster than, let's say, 30%, the stock's probably going to consolidate for a while, like a year, and then we'll see what happens after that. Because this stock's been places. It's just we can't invest looking at the rearview mirror. Oh, is this going to keep working this way? Well, it worked because you saw their growth. Their cash flow went from like 0 to 50 to 240. It's like, yeah, man, that probably caught investors' eyes and, whoa, this stock's going to be awesome. And now the cash flow's crashing. So they're like, whoa, what's going on? We bought you because you were growing. You're beginning to slow down. We bought you because of cash flow, and now you're not making as much cash flow. So they got to fix those two areas. And then this stock will be attractive. If the opposite happened, if they continue to slow down and they continue to have slow free cash flow, it's head for the exits time. This movie's over. So that's my analysis on HIMS. Thank you for the super chat. 2 of them tonight, man. Very, very cool of you. And I hope you come back. And I hope my analysis was interesting to you. Thank you, sir. Michael Anthony lighting up the chat. Cool. Yeah, GenMab. So HIM's earnings was down, that people not buying that much, profits are down. Yeah, I think so. But I think that cash flow, the spend in CapEx, I mean, that's, it's probably somewhere in their financials that, hey, we're investing for this reason or that reason. We are starting a new business. We're, and if they have a good reason, it might be a really good idea. But hey, let's explain where that money's going. You just can't have these businesses, just burning money. Cool. Thanks for the tip. And then Michael Anthony, wait for the stock to dip to 32. Yeah, I would put it at a nice discount. Yeah, totally. Thank you, Stingray Rasta. Great to see you tonight. Thank you, sir. Adams Skidmore. Cool. Yeah, thanks for weighing in. Appreciate it. These smaller caps, they can really be great winners, but they could also be cruel, man. If they miss targets, they drop so fast. That's why there's a premium on these big caps, is they're pretty damn predictable. They come with a lot of conviction, and you pay for that conviction, right? So I do own some small caps, and I've done well with a couple, and a couple of them have freaking left scars on me. But that's, take your pick. Do you want to play it safe with big caps? Do you want to take high risks? I do both. I have some risky stocks. I have some safer stocks, and that's how I do it. All right, good stuff, man. We just finished a nice run. I'm curious to see maybe in their investor letter, they might have, and I think there's their CEO. Um, okay, so see how they didn't put a percentage on free cash flow. Yeah, your cash flow went down a lot. I wanted to see if maybe they explained what are you spending all that capital on? So scaling international markets. Okay. They might be working on some type of med device that they could sell to their customers. This is a lot like products that have been sold by other companies. Um, and they might be getting into that market, launching new specialties. So this might require some CapEx that they have to build some new capacity to deal with a med device product. Okay. So scaling one of the largest personalized care footprints. Investments in compounding infrastructure. This is where the CapEx is going. So they're having to build their infrastructure for the compounding. Got it. Okay. So that's where the capital's going. Well, if they can just manage that well and they can keep growing faster, that will be fine. Stock will work if they can grow. All right. So we covered HIMS. Anxious Hamster, how are you? Any thoughts on a pure copper play? Probably single most component for all. Oh, yeah, I hear you. The ones that, the one that let's ask Gemini, and then I'm going to suggest a couple of material companies. But, I've thought along the same lines you're thinking, and I haven't had a lot of success with it. Let's kind of ask Gemini and go from there. All right. Let's see if Gemini is going to come through. All right. So it went to a couple that I'm familiar with. So Southern Copper, and this is a stock that I invested in. They're an Australian company, and they produce a lot of copper. But to my surprise, it didn't perform as well as it would have liked. I ended up selling it. I'm currently in one material stock, and they don't produce copper. But Southern Copper, Rio Tinto, which is a big company, and it's actually a British company, and a couple of others. Let's take a look at Southern Copper and BHP. I have a valuation on BHP, but we'll start with Southern Copper. I might have Southern Copper as well. So these guys have been doing well. Look at that, Southern Copper. Very well. So market cap 114 billion, revenue 12.3. They paid dividend, P ratio at 26. They're priced too high according to analysts. Analysts think that it's priced too high. Price targets are lower. So the growth was good in 24 and 25. It's going to slow down in 26, really slow down in 27, and 28 looks like a good year. So, So what's going to cause a slowdown? Copper prices are going to stay high. Earnings per share grew nicely in 25. It should bring down, well, the P ratio is going to stay high. So that's why analysts are saying, yeah, this one's expensive. Let's look at free cash flow. So free cash flow is at 3.5 billion. So they're in the right space. So if I multiply that times 20 minus debt is what I would probably want to pay for the company. They don't have too much debt. So I think they're worth about 70 to 80 billion, and they're way above that. So this one wouldn't be a good investment for me. I think the gains are in. The gains are already in the stock price, and this thing can only go sideways or down. Now, BHP didn't have the prettiest financials, but they produce a lot of copper. What's been happening with these guys? So they have been going up. I guess they didn't stick around long enough. But last 6 months or so, it's been doing pretty good. 5-year, not good. But these guys do produce copper. They do a couple of things, but copper is one of their main materials that they unearth. And a lot of their mines are down in Australia. So Southern Copper, I think a lot of investors are thinking along the lines you're thinking and I was thinking. BHP might be worth considering. They pay a nice dividend. The forward P is much lower than Southern Copper. It's almost half. This is an Australian company. Nothing wrong with it. It's just out of my home country. I think they're a very well-run company, by the way. $149 billion market cap, $51 billion in revenue. Analysts do think it's a little expensive. These guys will report twice a year, so it's not like we get financials every quarter. In semi-annual growth, they haven't been seeing growth, which is unusual. If material prices are going up, how come these guys are not making more money? So that's been kind of a riddle that I wasn't able to solve. So I sold the stock, but it's been bid up. Up 20% isn't bad. So this is another option for copper. So yeah, you're thinking about something that's positive. It's just we got to get the right pricing on these stocks. We can have the right idea. We also have to get the right pricing on stocks. Stingray. Yeah, my mistakes are. Yeah, and quantum, that's high risk. And we're going to have to wait years to know which quantum stocks are going to work or which quantum companies are going to deliver on what they would like to do. Some of these quantum stocks are going to be worthless. They're going to be like, oh my God, we were never able to get a sellable product. And they're just they ended up being a 3-4 year experiment with no revenue at the end, no profit at the end. So quantum is just really risky for me. But I mean, A-Lab is risky, man. I own it. It's just, man, I don't overreact on that one. I've got a lot of nice stable stocks, and then I've got some risky ones. I've done really well with A-Lab, so I'm good. I'm up like 130%. So my favorite quantum stock is Google. They're a quantum company. Cool. DLO. Yeah, so copper stocks. That's a good theme. Copper is just going to keep being in demand. So did you see SoFi is dumping 1.5 billion shares? So I haven't caught up with SoFi. I think they announced, right? So no, they announced before. Got it. So they're going to issue out shares. So this is a surprise because if you have lower interest rates, why wouldn't you just take on some debt? They're doing well. Take on some debt. Don't liquidate the company. Interesting. Yeah, I looked at IonQ and it's far from profit. I'm a fan of Rocket Lab. Think it's a cool company. I just wouldn't invest in it, but that's me. I like fundamentals. Big fan of space travel, all that stuff. You're up 25% on BHP. Good job. Good. Cool stuff. All right. Chat is exploding. Nice. All right. So we are at the 3 hour mark. What's going on with the football game? Having to keeping up tabs on the game here. All right. We'll see what's happening there later. All right. So a couple of others that are worth taking a peek at. We looked at DocuSign. It didn't do all that fantastic. You know, Apploving's just been going bonkers, man. So this thing's just been really going higher over the last 5 trading sessions. I bought more shares here, and I know I communicated with a few people about this stock, and there was some investors want to get off the roller coaster here, and I was like, well, I'm actually buying more shares. So I bought more shares and saw them go higher. This is got its volatility, right? It's got really nice pullbacks, but overall, this is a really good stock. I bought this thing twice. I bought it, it went up. I think I sold it before it hit these peaks, and I was like, oh, I didn't want to. Why did I sell it? Why did I sell it? I told myself that like 50 times. It came back down to earth. I bought back in. That doesn't happen every time, right? Sometimes these stocks go up and they never come down, but I'm glad that was the case here. Apploving is a software company. They do ad tech, and they've just been cleaning up. Their P ratio is high, but as I'll show you, their growth is really high, and they've been accelerating their growth. They've been dominating the market, and they're getting bigger and really taking a big part of the market share to just dominate this particular part of the industry. They're a very desirable business with very high free cash flow. Look at this growth of cash flow. That's what I want to see. Growth, consistent growth. We saw that HIMS went up and then down. We don't want that. We want it to just go up. We don't want it to ever come down, right? We want more cash. Margins, almost 80%. Profit margin, 44.8. Beautiful. Free cash flow, 53.87. These are ridiculous numbers. And that's why the stock's just going like gangbusters. And what's gonna, the addressable market for ad tech is huge. There's just going to be more advertising on all the social sites, the streaming services. This is a space that's just going to keep getting bigger. So I'm glad that I put more capital and I fed this winner. I just wish I owned 5 times more shares because it's gone up really well. So keep going up, Apploving, and give me a chance here or there to buy more shares. I think Apploving's discounted as I speak. It's discounted by 20%. On any pullback, I buy. I think the fundamentals will continue to improve too. So that is Apploving. Getting it done. Good job, Apploving. And here's a comment. You say too risky. Yeah, I'm with you. I'm good with volatility. Like Apploving's not the perfect example, but I guess if I understand the company and I understand what I'm buying, like this is a very special company. Like this has just been volatile like crazy. Just up, down, just all over the place. And I bought at the right times. So Astera Labs has been a super winner for me. So I'm good with volatility. Volatility is my friend. I like volatility. But not crazy volatility. Not just, hey man, let's just all I own is roller coaster rides. Man. How about 30% of my portfolio is roller coaster rides? 40% is solid. 30% is, call it safe. And I'm not considering like, our friends over at Google. This has been a huge winner for me. I've made well over 100 grand on Google this year. And this thing's been, it's been volatile. It's had its moments, right? But it's Google. And this is like a good part of my portfolio is right here, like high conviction, very solid. And then I have A Labs and I have companies that are smaller. For example, United Therapeutics. This thing's had its moments, right? It's had its moments, but overall, yeah, I'm doing great. Sign me up. I like volatility, but I like it served with good fundamentals. It's like I like hot sauce, but you got to serve it like with a really good entree, right? Like some fish tacos, some grilled fish tacos, some hot sauce. Yeah, now we're talking, baby. Serve that volatility with some solid substance, some solid fundamentals. And I am a player. So let's keep that volatility coming so long as it's making us a lot of money. Bo, my man Bo. So yes, is Google not bigger than? Yeah, Google's way bigger. Apploving is only 220 billion, in market cap, and Google is like knocking on the door of 4 trillion. So Apploving is going to be more volatile. They're going to grow faster. They could really continue to appreciate well. I've checked out ASTS. Yeah. Space Mobile. Man, what a day. What a day. Whew. Up 245%. Look at that. And for a while, this thing was just doing nothing. And then all of a sudden, bam. What happened? Did they do something exciting? So, Space Stock Tracker. So nothing, no news from the company. So just keep this ratio in mind. 27 billion and it's an $18.5 million company. So you're paying like 1,000 times sales. That's like incredibly expensive. Super expensive. Revenue beginning to grow. That's what's, I guess, exciting everybody. So they have a gross profit and then boom, a lot of losses. So I'm a big fan of space. You get me in front of like an awesome space documentary, I get locked in, man. Like I saw one on um, Neil Armstrong, and it's not the movie with that actor. It's Ryan Gosling, not with Ryan. He did a really nice job, by the way. I think it was his was First Man. It was a good movie, but the documentary on Neil Armstrong, phenomenal. That dude was like incredible. He did like test piloting of these airplanes that flew really high, really fast. He had a couple malfunctions where he had to survive. And then he was in the space program. He was the first guy to walk on the moon. And I get locked in on that stuff, man. Super fan. But I look at their fundamentals and I'm like, yeah, pass. I'll keep making money on Meta, Google, and Apploving, and all these companies that make gobs of just gobs of profit, gobs of cash flow. And I'll continue to be a fan of space. I was in Houston this summer, went to the Space Center. And if you ever go to Houston, I would suggest it. And I saw the Saturn rocket. Incredible it's like having a skyscraper building and then launching that into space. The rocket is that big. It's massive. And it was incredible to see that in person and then think, geez, man, that thing went into space. How? But it did. Actually, it did. The rocket didn't go into space. The capsule did. But that thing took off and got the capsule going faster than a speeding bullet. So space is not my bag. I'm also a big fan. Congratulations on Space Mobile, by the way. I hope you keep making money and kill it. It's just the fundamentals don't show me that this stock is worth 72. The fundamentals show me that this stock is worth $2, $3 a share, if that. But don't hang up on me. Don't get off the live stream. I'm just giving you my point of view. The other company I love is Rocket Lab. As a fan, but not an investor. I love the story of this guy, the founder of Rocket Lab. If you don't know it already, study it. Dude didn't go to college. He just loved rockets. He lived in New Zealand, in a rural area of New Zealand. Got into rocketeering, never looked back. Awesome story. Awesome. Love it. As a story, not a stock. I'll let other people make money for the time being, but it's just not, the fundamentals are not my fundamentals. I stick to my process. My process, I make money year after year. I compound it. Boom, boom, boom. And it's based on fundamentals. I can't fall in love with companies and become a fan and expect to make money. I need to look at fundamentals, look at the financials like we've done on this live stream. We looked at financials and we're able to decipher what's going on with the business, right? So that's my game, man. Good stuff, guys. The chat is exploding. Good stuff. Good comments. Good stuff tonight, man. You guys are bringing it. All right. So we talked about Apploving. Now let's talk about, did we talk about Meta yet? I don't know. Let's talk about Meta. So Meta's got the point. And if a lot of you guys are return guys, I know that Michael Anthony, geez, you've been coming to my streams for a year. Thank you. So when Meta announced, I called it out. They spent too much on CapEx. And the stock got just hammered. It went from 750 to 600. And I bought a lot of shares, by the way. I've been buying Meta like crazy. Because I know the culture at Meta. They push the envelope, they cross the line, and they crossed in on CapEx. And investors slapped their hands and said, don't do that anymore. We're going to sell your stock. So the leadership at Meta announced, hey, you know what? We're going to reduce our CapEx. And voila, the stock is really working now. So that was expected. And if now the free cash flow forecasts are going to get better, the stock's going to begin to work and we're going to go higher. And this trajectory is going to continue to go higher. We're going to $1,000 per share. Maybe by the end of 2026. And that's kind of what, Meta does that. They've been there before. They adjust, they get the message from the investing community and then they go for it. The other thing that was kind of lost, the EU is suing Meta because Meta is only offering Meta AI on WhatsApp in Europe. And WhatsApp is huge. Like a lot of people use it for communication. So Meta has a huge advantage because they're a monopoly, a dominant player in that space. And EU's like, no, you can't do that. You're only offering Meta AI. So we're going to probably fine Meta. But I think they're logically saying, yeah, we'll pay the fines, but we want to be a player in AI. And we're just going to offer ours. It's our platform. We own WhatsApp and we get to introduce Meta AI on it. I think it's a positive that they get to introduce it to so many people. There's over 2 billion people on Earth that use WhatsApp. That's how big it is. So if they get 2 billion, or I just guess it would be 4 billion eyeballs, assuming, 2 times 2, 4. That's a lot of eyeballs on Meta AI. That's a huge advantage. That's why I love Meta long term. They are in such a strategic spot with so many advantages because so many people use one of their apps. And I use all the big ones. I use WhatsApp a little bit. I use Facebook a little bit, Instagram a little bit, Threads a little bit. And there's some people that use it like 12 hours a day. And there's some people that use WhatsApp like 12 hours a day. That's their communication platform. Sometimes when like I'm traveling and I need to get a hold of my wife and our phone service isn't all that great, but it's for some reason I could call her on WhatsApp and it's crystal clear and it's free. And it's like, how is that possible? I pay for, mobile phone service, but WhatsApp, which is free, is even better. And we've noticed that, half dozen times in the last couple of years. So WhatsApp is a cool app and it serves up Meta AI. So I think Meta AI is going to be a thing for Meta. So it could hold its users and not see them go away to some other platform like ChatGPT. I think ChatGPT is going to have a hard time because it's going up against some giants, Meta, Google, Amazon. It's going up against some giants. And I don't know that they're going to have enough to overcome that type of competition, but we'll see. So the game looks like the Lions showed up to play some ball. 27-16. The Lions are leading the Cowboys. And man, these guys are playing hard. All right. So we talked about Meta. I'm optimistic that's going to go higher. And when you have volatility, back to that word, man, I like volatility. And you've heard me say that on videos and live streams is volatility is my friend because it gives me, I know businesses that I really find to be very desirable, very valuable because of their profits, their profit margins, and their free cash flow rates. And when the market sells these off, it gives me a great opportunity to buy these companies. So volatility is awesome. Give me volatility because I know the businesses I want to own. Like we talked about Cisco earlier. If you gave me the right price on Cisco, I'd be a buyer. And recently, the market decided to give me a 24% discount on Meta. Thank you. I'm on it. Bought more shares. So I'm good with that. So EVTOL. What's EVTOL? Archer Aviation. Oh, aerospace and defense. Okay. Well, no, I'm not big into aerospace. The margins, it's not a high margin business. So are these guys making money yet? No, they don't even have any revenue. So these guys, maybe they end up, having a lot of revenue, but margins will be low. Let me give you an example. A very successful company is RTX. They do planes and all kinds of stuff. We've been looking at a bunch of 80% margin companies, and these guys are at 20%. So the best you can do is 20% profit margin, because 20% gross margin is your limit. Well, you got Meta 80, 85. You got Apploving way up there. You got these companies way up there. Those are the companies I want to own, not these. So Archer is probably going to be in that low margin category. And yeah, not for me, man. And the thing about it is some of these companies, they're really cool, right? Like, oh, wow, man, Archer, they're going to have like small aircraft. Isn't that cool? And it's a little bit risky. It's almost like, the movie business for, movies and making movies. It's a very unprofitable business, but a lot of people think, oh man, it's so cool to be in the movie business. Yeah, but it sucks to be an investor because you oftentimes lose money. And who cares if the movie was great if you lost money? We're here to make money. So I'd rather own stocks that are destined to make a lot of money, destined for their stock price to just really go up a lot over a 10-year run. So that is my preference. That's the lane that I'm in. All right. So Lions are leading 27-16. We're in the third quarter with 6 minutes and 55 seconds remaining in that quarter. All right, guys, let's start landing the plane here. We've covered a lot of ground, and I appreciate you guys attending. Looks like, do we have a pre-market number yet? So the futures slightly higher. Okay, what's crypto doing? Bitcoin a little higher. All right, let's see what we do tomorrow. So hopefully we end on a good note, but we shall see. All right, folks, that is it. We went 3 hours and 22 minutes. We covered more than 15 stocks, and it was awesome. Thanks so much for tuning in, everybody. Really appreciate the super chats from everybody. I appreciate all the chats, man. You guys are on it tonight. So, Bo, good to see you. Thanks for the super chat. Adam Skidmore, good to see you. Stingray Rasta, thank you so much for the super chats. Michael, Anthony, good to see you. We've got Atari Kid, good to see you, man. Thanks for tuning in and for your questions. Anxious Hamster, good to see you. Good to see that you're up on BHP, making some money on material stocks. I've tried to get in and out of materials, and I've done well in 25. And I do videos on material stocks, by the way. So you may have already known that. And Stingray Rasta, good to see ya. DJ, good to see you. Anderson, thanks for tuning in. Benton, great to see you. Grumpy Grandpa, thanks for reposting my stream on X. That was really cool of you. Benton, great to see you. Jeff Bardo, thanks for tuning in. Blocks for Fun, thanks for tuning in. Thanks for the question on Halo. And Bo, thanks again. Mark Stan, thanks for tuning in. And eToro has room to go higher, most definitely. And Blocks for Fun, Benton, Bo. All right. Said hello to everybody. Thanks again, everybody. I'm going to stream tomorrow with Daryl. So you get the combo, technical analysis and fundamental. And I'll stream over the weekend. So it'd be great to see you again. And I really appreciate the energy tonight, everybody. Thank you so much. Have a good night. Talk to you soon.